Welcome everyone to another episode of Financial 15, continuing our Becker Orr Original series here, how to fund your retirement. We've had multiple videos here, and today we're going into tax-efficient withdrawals. How do you get the money out in retirement and pay the least amount of tax? It's important, lots of good information. You definitely want to stick around.
Yes, another new episode that we have in our original series in regards to dealing with your retirement, how to get things out of your retirement income sources and a variety of different options. Again, if you want more on this video, please go to our YouTube channel. There's lots of stuff in regard to original series and everything else we've got, or you can like us on Facebook, or again, as I always stress, go to our website at beckerorr.com. Plenty of great information there. Besides videos, we got blogs, the whole 9 yards, worth looking at it. But today it's how to fund your retirement with tax-efficient withdrawals. We're going to describe exactly which way you should draw things out and go from there. But before we start with that, we have our usual source scenario. Clint, out of our little colored pie chart here, what are we dealing with today?
Yeah, and throughout the whole series, we've always started with this little colored pie chart. It looks at the different sources of retirement income. Broadly speaking, you have that green box there, which is the employer-provided pension, the orange box, your government pension, CPP, OAS, and of course the personal savings. And that's the purple box there. That's what we're diving into today, Kevin, is looking at how do you handle those personal savings accounts in a tax-efficient manner so you can fund your retirement with more of it going to you, a little less going to the government. And a reminder, though, what the purpose of all these sources of income is to meet your needs, your retirement incomes. You need to have a target. You need to know what you're working with, which means, Kevin, you're probably going to have to do not a fun exercise, but one that's required, which is to have a budget.
Yeah, having a budget, that is always the first thing that you really need to do. Too many people just want to get into retirement. Oh, I've made it here. Now I can survive and do this. You've had a regular paycheck most of your life up to this point. Now you have to make sure that now that you don't have that regular paycheck and you're drawing money out of places, how do I pay for things? But what do I pay for? That's a big factor. You need to know what your expenses are on a monthly basis and on a yearly basis, and that way you can provide from there. So once you know those numbers, all of these situations between employer, government, and personal are all worthwhile to get your retirement income that you need. But today we're talking tax efficiency, aren't we?
We are. And we've done other videos on how to help out determine your budget, so we'll link to those so you can always check them out. But in terms of tax efficiency, we've got these investment accounts, part of that purple bubble, that personal savings in the prior chart. How do you pull them down? Do you start with the RRSP? Do you start with the TFSA, the non-registered account, different tax consequences? So this is our order of withdrawal. So if you're going to be taking money out, typically you want to follow this pattern, right? So you'd start with the most taxable, Kevin, which are going to be the RRSP, is going to be the RIFs, the lifts, the whole acronym soup there that is the registered accounts in the investment world. Those ones are fully taxable. You take the money out, there's no dividends, nothing of that nature. It's all going to be full income, so a high tax bracket. Often we include corporate accounts in there as well. A few different tweaks when it comes to corporate accounts, but we view them on the same level when it comes to order of withdrawals. So you want to start with the most taxable and then work your way down. What are some of the other pieces here, Kevin?
Yeah, next after that, we get to our non-registered accounts. And as you mentioned above, it's taxable registered accounts because not all registered accounts are taxable. Yeah. But after that scenario, we're going to the non-registered. So that could be anything that you've got in your non-registered could earn interest income, dividends, capital gains, return of capital. These all have different tax rates that are applicable. They are much more efficient in most cases than what the taxable registered account is because that's all income. Interest income, as you notice, is the only fully taxable income there. Dividends give you a dividend tax credit. Capital gains give you a 50% inclusion rate, so you're not showing the government everything you've earned. And the return of capital, of course, there is no tax when this income is received. It lowers your ACB, and at the end of the day, that's going to turn into a capital gain when you sell it. So again, more tax efficiency, but this is less, on most cases, taxable than your registered accounts above. That's very important that you're doing the steps this way so that you can get more money in your pocket than what the government has. And after we've done our non-registered accounts, Clint, where do we go from there?
Yeah, the last bucket of money, the last pot of money we typically have is the TFSA. Now, technically, it's a registered account, but it is tax-free, hence the name, tax-free savings account. So we usually save that one to last. So if you're going to be withdrawing money, you want to start with a fully taxable, which could be the RSPs, the RIFs, get into that middle account, the non-registered funds if you have them. And as you mentioned, there's a few tax perks there. I should mention the non-registered, like a pay-as-you-go system. Every year, you're going to have to claim a little bit of the gains on your tax return. So that one, a little more tax efficient. And then your last pot of money is typically the TFSA. We normally leave that one for the end. So in terms of withdrawals, you can see the 3 steps here. Top of the list, fully taxable registered accounts, then the non-registered, and then typically the TFSA. we leave for last. But that kind of brings us to a question, right? We started off with the needs with that colored pie chart. Say, all right, we need this much money, a different source of income. We now know the order in which we take the money out, which account to start with. Well, how much do you actually withdraw, Kevin? It's not just as easy as we just take what we need and that's it, right? There could be some tax tricks here to take a little extra and still have an efficient income. And that's what we'll get into here. I'll pull this up and you can walk us through this number C here. There's lots of numbers on the charts.
Yeah, I mean, one of the big things is that you don't just take out what you need possibly. Maybe you're taking out a little more. Maybe you're taking out more tax efficient income or things along those lines. But what we've got here for us is a charting that lists each province and territory that we've got and what we're dealing with. Now, we've used a lower limit, which, as you can see, is almost exclusively at the 50,197 mark, with the exception of Nova Scotia in there. But if we had 60,000 that we're taking out, the rationale that we're dealing with on this is we're over that 50,000 lower limit. But the upper limit is the next change before the tax bracket. So theoretically speaking, as we are in Manitoba here, if we had 60,000 that we drew out, we are in that tax bracket between 50,197 and 74,416. We're paying at 33.25%. So if we went all the way up and added another 14,000 plus in there, we're still in that same tax bracket. We're not paying more tax in a percentage basis. We're still in that bracket. That may be something to consider to maximize the bracket, so that if we have registered assets, we're taking the money out of there at the same tax. We can put it into non-registered, or maybe we have room in our TFSA. We can put the money in there so that going further down the road, we don't have the same tax consequences we do here. That's sort of a summary of it. What else do you want to add on the bracket scenario?
Yeah, that's exactly it. So what's on the screen here specifically, you're absolutely right. We want to try to fill up the bracket. We've done an analogy here using 60,000 as our example. Let's say you had 60,000 of income from your employment sources, from CPP, OAS. Well, that'll put you in this respective bracket. And we said, well, 60,000 in Alberta, BC, Manitoba, what bracket would you be in? Went across all of them. So we just look at one tax bracket for province or territory. If you want all the tax brackets, and these are combined federal and province, you can go to the link on the site there, taxtips.ca, and then you simply click your province and you'll get the full tax brackets for your particular province. We used one example, said if you had 60,000, what would it look like? And the idea here, as you mentioned, Kevin, it's looking at tax efficiency. Of course, you have to start with your needs. Remember that colorful chart, that yellow circle, the retirement income? You have to start with that. Make sure you at least get your needs. And then after your needs are met, well, how do we be more tax efficient? That's where this chart comes in. Ideally, trying to fill up your tax bracket, looking at that registered taxable accounts first. And all right, our RRSP, for example, well, if we have 60,000 Manitoba, let's take a little extra out of the RRSP, a little 14,000 extra, not paying a higher tax rate. We got that extra income out. If we don't need it, we can reinvest it in another account. And then we do that year in, year out. We're efficiently getting the money out, doing those tax efficient withdrawals, which means in the long run, you're going to end up paying less tax, a little more in your pocket, which I don't think that hurts in retirement, having a little extra in your pocket at the end of the day.
No, not at all. And another thing to consider, just based on some of the tax brackets there, is if you're noticing in Alberta or Saskatchewan, they typically go up to 100,000 before the next bracket. But we must remember, if people want to collect their OAS in full, there are certain limits before the clawback comes in. That's around that high 70, low 80 mark. So even though you may want to maximize out the entire bracket, just remember that if you go too high, you may start clawing back your OAS. And that may be something that we don't know whether or not you want to add, or whether or not we have too much in our registered to be able to take out on that sort of a side.
Yeah. So we're covering the building blocks here. So in terms of tax efficient withdrawals, the building blocks, of course, you have to start with your budget. How much do you need? You start with the order withdrawals, which goes from the registered taxable accounts to the non-registered to the TFSA. And then within your bracket, you try to get some extra out within your bracket to be tax efficient. We're looking at a simple scenario here with one person with $60,000. As you mentioned, Kevin, it can be a little more complicated.
Yes.
For example, if you collect an OAS, you probably don't want to go over the OAS threshold and have a clawback. Also, if it's a couple, it could be a situation where maybe doing income splitting, which is a little more of a complicated calculation than when it comes to your tax bracket. But those building blocks that we talked about would be the same, right? Starting with your needs, going through the order of withdrawals, then ideally, where possible, being efficient and trying to maximize your tax bracket. Those building blocks would be the same. And then you just layer in the details for your specific situation, which really comes down to why we believe everyone should have a financial plan to reflect their specific situation. Anything you wanted to add?
Yeah, I mean, basically, as you mentioned, it's the financial plan scenario. So again, this is more of a high-level scenario. We haven't dove deep into each scenario, but the one thing to remember out of all of this is the way you really want to withdraw is the most taxable first, then the stuff that has some tax breaks, then the tax-free. If you follow those 3 stages, that's going to give you the most money that you can have in retirement at the end of the day, the least amount going to the government. And at the end of the day, you want as much in your pocket as you can. If you have any more questions, though, and you want to get in touch with us on this topic, any of our other How to Fund Your Retirement or videos that we've done, please visit us at chatwithclintonandkevin.com. We're more than happy to answer any of the questions on there. Please also check out the videos. Clint's mentioned a few here that will help with this process. And other than that, I think that's all we need to do for today's video on efficiency.
I think we've covered it all. We'll be back again soon with another video. Take care.